And for more on China's stock markets, we're joined by Anthony Chan, chief economist at Chase Private Client and a member of JP Morgan's Global Investment Committee. Anthony, Happy New Year. Good to see you. Quite an exciting start to the year. Very, very volatile markets across the globe. Let's start off with China. They did close up today, the Shanghai Composite closing up 2% after trade was suspended twice this week with those circuit breakers kicking in. Why the reverse sentiment today?
Well, I think clearly the fact that regulators reacted positively and certainly were flexible, gave some confidence to the market. The circuit breakers obviously were too restrictive, a lot more restrictive than we have in the United States. The fact that the currency was being weakened and they reversed course and strengthened the Chinese yuan a little bit, all those factors were viewed very positively by investors.
Does the market volatility, though, create a loss of confidence in terms of regulatory policy?
Well, there's no question that the volatility does, in fact, hurt confidence, and that's exactly why the regulators move so aggressively to try to stabilize the financial markets. One of the things that I give great kudos to the regulators is that when something doesn't work, they alter the policy. They don't remain stubborn and continue on the same course.
Well, there was a lot of shifting and changing. The circuit breakers implemented, then suspended. Also this week, $20 billion was injected into the financial system. There are still restrictions in place on some trading moves that one can make. What next do you think regulators will do?
I think regulators will certainly try to pursue market-friendly type of regulations and try to alter and change policy to make sure that the financial markets remain stable and that there's no further loss in confidence. Also, one of the things that will boost confidence is to see the economy doing a lot better. You mentioned the liquidity that was added, but they're also spending quite a bit on infrastructure projects. They certainly are going to probably lower interest rates some more, lower reserve requirements. All those things should bolster confidence.
Well, let's talk a little bit about the yuan. It was boosted on Friday, but it did hit a 5-year low on Thursday. What impact is that having?
Well, I think that the markets don't want to see a free fall in the currency. There's no doubt that that currency will continue to get weaker. The Chinese on December 11th made it very clear they no longer target the Chinese yuan against the U.S. dollar. They're now targeting against a basket of currencies, and guess what? The basket of currencies led by the euro has been much, much weaker, so the yuan is got to be weaker.
So you feel that it is more in reaction to overall market trends, the movement in the yuan?
I think the movement in the yuan is exactly a reflection of what's happening to most of their major trading partners, whether it be the Korean won or the Taiwanese dollar. All those currencies are, in fact, getting weaker, and the Chinese currency has to reflect that.
Well, Anthony, as we've discussed before, the Chinese market is made up of the majority of retail investors, mom and pop investors. It's not as integral part of the economy as the U.S. market is to the U.S. economy. And it's not really seen as a true barometer of the Chinese economy, is it?
Oh, absolutely not. I think you're spot on, because when you look at movements in the economy and movements in the equity market, they diverge. If you go back to 2008, back then the equity market, the Shanghai equity market went down 65%, and yet the economy on a year-over-year basis was growing at 9.6%. Go ahead and rewind to last year in the second quarter. Guess what? The economy was growing at 7%. And the equity market was up 109% year over year. So there is not a very tight link.
So given the Chinese stock market is not really correlated to the economy and not an accurate reflection of the economy, why did the Chinese sell-off trigger this global sell-off? Was that a knee-jerk reaction?
Well, I think there's nervousness. And in fact, even though there's not a tight link between the economy and the equity market, that doesn't necessarily mean that that's not going to hurt consumer confidence precisely at the time when the Chinese are trying to transition the economy from a manufacturing-based to a consumer-based economy. And other global markets got nervous because of the currency situation.
You mentioned that transition, and that is something that billionaire investor George Soros hit on. He said that China is struggling to find a new growth model that's impacting the rest of the world. And he also mentioned the return to rising interest rates here in the U.S., what impact that has on the dollar and what impact that has on emerging markets. And George Soros is warning that all of this could create a perfect storm and that we could be in for another financial crisis. He says this could be 2008 all over again.
I really don't think so, because the Federal Reserve is just raised interest rates by 1/4 percentage point. The average increase going back to the 1970s during monetary tightening cycle, 2.25%. By the way, the average increase during monetary tightening cycle during presidential election years going back to the 1970s, about 50 basis points. So the Federal Reserve, in fact, only wants to raise them 100 basis points, which I think they may end up raising them a lot less. So less probability of a financial crisis.
So, Anthony, very quickly, outlook for the U.S. market and China market next week.
I think next week the markets start to stabilize a little bit. It's not going to happen right away, but I think as the days and weeks proceed, we'll see stabilization in both markets.
All right. Thank you so much, Anthony Chan, Chief Economist at Chase Private Client and a member of JP Morgan's Global Investment Committee.